Europe's recent shift from U.S. natural gas to Canadian energy supplies is causing major ripples across the global energy market, raising critical questions about the future of U.S. exports and their economic impact. This dramatic change isn't just about energy, it's about a total reshaping of alliances, market forces, and geopolitical influence. The catalyst for this transformation can be traced to the war in Ukraine, when Russia's gas supply to Europe was severely disrupted due to EU sanctions. Europe found itself in a severe energy crisis. At first, the U.S. appeared as a reliable ally, sending large quantities of liquefied natural gas, LNG, to Europe, helping the region survive a harsh winter. The U.S. energy sector seemed to have saved the day. However, this relief came at a steep price. U.S. gas prices were much higher than global market rates, forcing European governments and businesses to realize they were paying a premium. The cost of U.S. LNG became unsustainable, and there were growing concerns about Washington's unpredictable trade policies. Each new administration brought new energy policies, which made Europe wary of relying on the U.S. for long-term energy security. As a result, the United States was increasingly perceived not as a stable ally, but as a strategic actor leveraging energy exports as a political tool. This growing uncertainty, coupled with rising LNG prices, prompted Europe to explore alternative energy partners. Canada, with its vast natural resources, emerged as a logical choice. The country boasts abundant oil, gas, and critical minerals like lithium and cobalt, which are essential for the electric vehicle (EV) revolution that Europe is heavily investing in. However, it wasn't just Canada's energy resources that made it an attractive option. It was also the stability and predictability of its trade relations with Europe. Unlike the U.S., where policy shifts often accompany each new administration, Canada has consistently maintained long-term cooperative economic ties with Europe. Moreover, Canada's commitment to clean energy, including solar, wind, and hydroelectric power, aligns seamlessly with Europe's green energy objectives. While the U.S. remains heavily reliant on fossil fuels, Canada is already transitioning toward a more sustainable energy system, further enhancing its appeal as a partner for Europe. This shift toward Canada not only undermines U.S. energy dominance, but also represents a significant economic setback for the United States. The EU was once the largest buyer of U.S. LNG, but with Europe now turning to Canada, the U.S. stands to lose billions in annual revenue. The American energy sector's reliance on foreign markets is coming under scrutiny, and its influence over Europe is increasingly at risk. The implications of this pivot extend far beyond energy. Canada's ability to supply critical minerals for EV battery production solidifies its role as a key partner in Europe's clean energy future. Meanwhile, stringent U.S. environmental regulations, which hinder its ability to mine these essential materials, make the country less competitive in this growing market. The geopolitical consequences of this shift are profound. For years, the U.S. has used energy exports as a tool to exert influence over its allies. If Europe can rely on a politically neutral alternative like Canada, it undermines Washington's leverage in global negotiations and weakens its position in international affairs. This shift could trigger cascading effects on U.S. foreign policy, presenting a significant challenge for Washington as it seeks to regain its influence. Amid rising tensions, the U.S. and Canada have entered a trade war that could reshape both North American and global economies. The U.S. has recently imposed tariffs on Canadian imports, including energy products, prompting Canada to retaliate with its own tariffs. However, this conflict goes beyond tariffs on consumer goods. It is heavily focused on energy. As the dispute escalates, Canada is already diversifying its energy exports, with a particular focus on Asia, especially China. This strategic move further underscores the shifting dynamics in global energy markets and the growing strain in U.S.-Canada relations. The expansion of the Trans Mountain Pipeline, designed to boost oil exports to China, Japan, and South Korea, signals Canada's strategic move to reduce its dependence on the United States. China, with its enormous energy demands, has emerged as a critical partner for Canada's oil industry, and the two nations are steadily strengthening their economic ties. If this trend continues, Canada could significantly diminish its reliance on the U.S., a shift that would have far-reaching implications for the global energy market. But what if the U.S. suddenly lost access to Canadian energy supplies? The consequences could be catastrophic. The U.S. imports over 6 million barrels of oil per day, with nearly 67% of that coming from Canada. If Canada were to cut off or reduce its oil exports, U.S. gas prices would skyrocket, particularly in the Midwest, where refineries are heavily dependent on Canadian heavy crude. This would not only drive up fuel costs, but also increase production expenses across industries, from transportation to food and consumer goods. The ripple effect could lead to higher prices for virtually everything, potentially triggering a severe recession. U.S. refineries are not equipped to process other types of crude, and a sudden loss of Canadian oil could force operational shutdowns, creating a massive economic shockwave. While some players, such as major oil corporations like ExxonMobil and Chevron, might benefit by ramping up shale oil production, this shift wouldn't happen overnight. Replacing Canadian heavy crude would pose significant challenges, requiring substantial investments and likely facing environmental opposition. In the meantime, global players like OPEC, Russia, and China could exploit the situation to manipulate oil prices and expand their influence over the energy market. This raises a critical question. How will the U.S. respond to these growing tensions? The stakes are high, and the outcome could reshape the dynamics of North American and global energy markets for years to come. The Biden administration faces a difficult dilemma: continue the trade war with Canada or negotiate a new deal that benefits both nations. If the U.S. persists with tariffs on Canadian imports, Canada may retaliate by cutting off its oil and electricity exports, which would drive energy prices higher and destabilize the U.S. economy. Alternatively, the U.S. could seek to negotiate a new energy deal to stabilize relations and protect its interests. Another option is to ramp up domestic oil production to reduce reliance on Canada, but this approach comes with significant environmental and regulatory challenges that could take years to overcome. Canada, however, isn't passively waiting for the U.S. to act. In response to the tariffs, Canada has launched a boycott campaign, urging its citizens to support domestic goods over American imports. Provinces like Quebec and Nova Scotia have already removed American-made alcohol from shelves as a direct act of resistance against U.S. policies. This economic protest highlights Canada's determination to protect its sovereignty and push back against U.S. tariffs. The implications of this trade war extend far beyond energy and raw materials. Major U.S. manufacturers, particularly automakers like General Motors and Ford, rely heavily on Canadian raw materials for production. If the trade war continues, rising production costs could push U.S. manufacturing to the brink. Tech companies like Apple and Tesla would also face higher costs for components sourced from Canada, eroding their competitive edge. Even smaller manufacturers dependent on Canadian raw materials could be forced to shut down or lay off workers due to escalating production costs. The ripple effects of this conflict could reshape industries and strain the economic ties that have long defined U.S.-Canada relations. The U.S. economy, already strained by inflation, could face even greater challenges if trade tensions with Canada continue to escalate. The stock market is likely to take a hit as investors grow increasingly wary of the long-term consequences of a prolonged trade war. The tourism industry, which relies heavily on Canadian visitors, could also suffer significant losses. Canadian tourists are a major revenue source for the U.S., particularly in states like Florida, California, and Texas. If Canadians cut back on travel and spending on American goods, the U.S. could lose billions in annual revenue, further deepening economic instability. This trade war and energy standoff are rapidly evolving into a global crisis. The relationship between the U.S. and Canada, long defined by economic cooperation, now risks becoming a fierce battle for control of the energy sector. While the U.S. could lose access to critical energy supplies, Canada is strategically diversifying its markets and securing its economic future.
This conflict isn't just about two nations. It's about the future of global trade, energy markets, and international diplomacy. The outcome will shape how both countries navigate an increasingly interconnected and volatile global economy. The world is watching, and the stakes have never been higher. In recent weeks, however, political tensions between Canada and the United States have shown signs of easing. The 30-day suspension of tariffs has provided a temporary reprieve, allowing Canadian political parties to shift their focus toward lobbying and other priorities. While this pause offers a glimmer of hope, the underlying issues remain unresolved and the path forward is uncertain. If you found this analysis insightful, don't forget to like, share, and subscribe for more deep dives into global economics and geopolitics. Let us know in the comments what you think about the US-Canada trade war and its potential impact on the global economy. Stay tuned for more updates, and we'll see you in the next video. Thanks for watching.